Hi guys, and welcome to another episode of Ethical Investing with me, the Urban Hippie. Today we're going to have a chat about the four fundamental principles of property investing, the four pillars, if you like, for wealth creation. And the first one of those is to buy long or never sell. So what we mean by that is in Australia, the average length for doubling in value for a property of time is 7 to 10 years. We've all heard of the property clock or the property cycle. So 7 to 10 years is on average what it takes to double in value for a property in the capital city in Australia. So if we want to turn our wealth creation into very, very low risk, then what we need to do is hold for 10 years or longer. Okay? When we say longer, we're talking about never selling. And there's a couple of reasons for that. One is creating generational wealth, which means we're passing our wealth onto our children. And the other is we want to minimise our exposure to things like tax. And the two taxes in property are estate tax, which is land tax, and a federal tax, which is capital gains tax. So in both of those cases, we want to minimise our exposure to them. So in land tax, or the state tax of land tax, we want to buy below the land tax threshold. And in capital gains tax, if we never sell, we never have to pay capital gains. And therefore we're passing it on to our children. Another cool thing in Australia is we don't have inheritance tax. So our children get to, or our estate gets to inherit our properties tax-free. So we're going to discuss those later in another episode, but the next one we want to have a look at is number 2, and that is yields or rents should cover our holding costs. We're not discussing negative gearing. Negative gearing is exactly as it says, it's negative, and we want to be looking at neutrally gearing to positive gearing. We'll discuss in another episode how negative gearing came into play and a little bit more about that. But this is a business, and in business we want to make a profit. So I've never understood the whole idea of going out and buying something that loses money against something that's profitable. And again, we'll have to discuss that in a little bit more detail in another episode. But our number 2 fundamental principle is yields or rents should cover our holding costs. Number 3, the cash rate, the rate that we're borrowing our money at, should be less than the capital growth on the property. I'll say that again another way. The capital growth of our property should be less than should be more than the cash rate, the money that we're borrowing from a bank. So if we're currently getting interest rates at 5%, which are achievable everywhere in Australia, then we'd like to see a capital growth of around 7%. And again, that's not a hard thing to do in today's market. And number 4, what I believe is the most important of them all, and the one I think most Australians miss. In fact, probably most people in the world. We must, in investment property, have our properties tenanted. If we're going to borrow money from another source, e.g. a bank, then we must have another source pay that off. And that's the balance. That's the ethical way. The yin-yang, if you like, in this whole structure is if we're borrowing money from another party, we must have another party to keep that balance, paying that money off. In this case, that's the tenants or the rent. So number 4, which underpins all the rest, is that vacancy rates shouldn't exceed CPI. Now this is something that I've put into the mix after 21 years of investing and studying the market and studying property. CPI, of course, is the consumer price index, inflation, cost of living, whatever you'd like to call it. In Australia, our CPI index has been fairly static. It's fairly averaged at around about 3% for the last 40 odd years. So what we're looking at is areas that are below that 3%, below that vacancy rate. Okay, vacancy rate is obviously on supply and demand, and something that's very interesting, and this is a long conversation, it's not just as a simple fact that I've geared vacancy rates to a low number, which is CPI. There is actually a correlation between the two. If we actually go out there, I've noticed that vacancy or rental increases in Australia have gone up on average 2 points in front of CPI. So that means we've had an average rental increase or rental yield of about 5% per annum in Australia for the last 35 years. So all of this data is available under the Freedom of Information Act through our Australian Bureau of Statistics, and again, we can discuss this at length later on. But the easiest way to have a look for find vacancy rates, if you've got an iPhone, just ask Siri, what's the vacancy rate for Brisbane? And you will see that it comes up at around 2.3% currently. Sydney's roughly at 1.7%, and Melbourne's at just a little tad above 3%. So these are the things that we're looking at. And if we've got a vacancy rate that's less than 2%, that's not even 2 weeks in a year. And we're quite okay with that. So again, we're just working with the numbers. So my 4 fundamental principles, guys, if we just go through those once more. Number 1, buy long. We don't sell. This is generational wealth. Number 2, our yields or rents should cover our holding costs. Number 3, the capital growth should exceed the cash rate. This is a business. Our profit should exceed our costs. And number 4, our vacancy rates, because it's vitally important that the stock we're buying is tenanted. It's not a grey area, it's black and white. Our vacancy rate should be below CPI, the Consumer Price Index or cost of living. If we remove any one of these 4 pillars, it falls over. As soon as you take one of those away, we have to acknowledge at that point that the decision we're making on the property that we're buying has just become emotional. Now, I don't have a problem with buying property emotionally. Our homes are emotional purchases. What we don't want is to buy investment property emotionally. That's the ethical way. If you'd like to know more, just pop onto our website. You can go in and fill in one of our forms, and somebody will be in contact, or give us a call on 1300 Yin Yang. Thanks, guys.